Okay, hello and welcome to this lecture video. In this lecture video, I'm going to be covering the balanced scorecard. Start off by covering the balanced scorecard. Then I'm going to talk about transfer pricing, and then I'm going to talk about joint costs and how to allocate joint costs. Okay, so let's talk about the balanced scorecard. So, balanced scorecard is a way to measure. It's a performance measurement system. So it's a way to measure performance of a company or any organization. So typically, when we think about measuring performance of an organization, we think about it in terms of financial performance. So I'll take Hewlett-Packard, for example. How well is Hewlett-Packard doing? We could look at their earnings per share, look at their net income, their return on investment. Financial measures seem to dominate the thinking about how to evaluate a company. And so in the early 1990s, Robert Kaplan and Norton, they created the balanced scorecard. So the balanced scorecard takes a broader view of how to evaluate an organization. So rather than just only focusing on financial measures, the balanced scorecard says, let's take a look at other dimensions or other facets of an organization's performance. So, for example, it would look at the customer perspective. So, with regard to the customer perspective, you'd want to think about one measure of that might be customer satisfaction. Are our customers happy? Right? Do they like our product? Do they like the service that we're providing? Another way that you might want to measure a company would be something called the internal business process perspective. So in terms of the internal business process perspective, we'd want to be thinking about things of, how long does it take us to fill a purchase order? Or in the terms of Mary Washington, we could say, how long does it take students to receive the advising that they need? How long does it take them to register for classes? Those are all measures of how well the internal processes within the university are working. And then the last one is called our employee learning and growth perspective. And so with the employee learning and growth perspective, we want to look at things such as some measures such as employee turnover. How long are our employees staying? Are they quickly leaving the company, or are they staying for a long time? What about their employee morale surveys? What about asking employees for suggestions? What about also the amount of training that employees could receive? Okay, so I'm going to flip the page over. I'm going to take a look at this balanced scorecard right over here. So the balanced scorecard has 4 perspectives. And so the top one is the financial perspective. Okay? And this page that I have in your course pack on page 270 shows the other 3 perspectives, but the first one is the financial perspective. In one performance measure could be earnings per share. Okay? Earnings per share, which we would take our income divided by our number of shares outstanding. And then that shows us our earnings per share, or EPS. Okay? So we could measure how well is Hewlett-Packard doing by looking at their EPS. But we could also look at the customer perspective. This is another dimension or perspective in the balanced scorecard. Like I said, there are 4. This is the first one. Here's the second one. How can we measure the customer's perspective? By customer satisfaction, maybe customer complaints, and what the customer perspective is trying to get at is how happy are our customers? How much do they like us? Okay. The third perspective in the balanced scorecard is called the internal business process perspective. And as I was giving the example earlier about advising with Mary Washington, how well can we do advising? That is a measure of how efficient are our processes inside the inside the university. Okay, so some other measures that we could look at if we're a manufacturing company, for example, we could say, what about defects, defect-free units as a percentage of our total units? Okay, with the thought that we don't want to have very many defects. All right. We could also look at how long does it take us to make new products. Okay, time to introduce new products to market. And then the fourth perspective of the balanced scorecard, our employee learning and growth, gets to measures that look at how happy are our employees. And so, for example, we could look at suggestions for employees, we could look at employee turnover, and we could also look at training for our employees. Continuing on with the lecture here, the next topic that I want to talk about is transfer pricing, okay? So the transfer price is a price that's used to value internal transfers of goods or services. So for example, if we have a battery division within a company, and then they transfer batteries to the car division. So we have a battery division, and then we have a car division. And so basically what happens is that the battery division is going to transfer their batteries to the car division, okay? Or they could internally sell them to the car division. That's another way to think about it. And so when we talk about the transfer price, what we're saying is, what price should the battery division charge the car division for these batteries in terms of this internal transfer of these batteries? Okay. Now this revenue can only be recognized for the battery division inside the company. We can't recognize that for external financial reporting purposes. So we can't say, hey, the battery division made a sale to the car division, and we can recognize that as sales on our financial statements that we send to the Securities and Exchange Commission. Can't do that because it's not at arm's length. It's not an unrelated party. Okay, so this we could, well, but if we had a departmental income statement for the battery division could recognize that as revenue inside the company, but not external to the company because it's not arm's length. Okay. Getting back to what price should the battery division charge the car division? Well, there's a couple different options that we have. We could charge the market price. This would be the best option in my opinion. But this assumes that there is an external market for these batteries. So if this battery division could sell their batteries out on eBay or any external market for $15, then it only makes sense to charge the car division that market price. There's an external market for it. That's easy. But the problem comes in when when there's not an external market for these batteries. In that case, we have to look at other options. One option would be the variable costs. So the battery division could say our variable cost per unit were $5, and so that's what we're going to charge the car division, simply the variable costs of making those batteries. The other option would be to do the full cost plus the profit. Now, full cost, remember that includes the variable cost plus the fixed cost plus some profit. I'm sure that the battery division would like to do that, but the car division may push back because obviously that will be a higher price than simply just the variable cost. So the car division may push back and say that's just too much. But the difference between these two is that this is only charging the variable costs from the battery division to the car division. This would be charging the variable and the fixed cost plus a profit plus an extra fee. The final option that we could do is say that the manager of the car division and the manager of the battery division would negotiate some prices. They could negotiate it, and that could be a final option. Okay? So I'm going to go ahead and flip forward over here to the talking about joint costs, because what I just kind of summarized were those few pages in your course pack talking about transfer pricing. And so in that little discussion, I summarized all those bullet points. Rather than going through each bullet point directly, I gave you a big summary. And for transfer pricing, that's what I really want you to understand is kind of the big picture and what are the options for transfer pricing. Getting back to the balanced scorecard, what do I want you to understand for the balanced scorecard? I want you to understand that there's 4 perspectives, and I want you to have a general understanding of the measures that would be going into each perspective, okay? So now let's talk about joint costs, right? I'm on page 273 of your course pack. And so when we talk about joint costs, what we're saying is that some companies make end products from a single raw material, okay? And so if we flip over here, we could look at some examples of some joint costs. And so one might be something like if we buy cocoa beans. We have cocoa beans, and that's raw materials. We have cocoa beans, and what we make is we can make cocoa powder, or we can make cocoa butter. The cocoa beans, the price of those cocoa beans is shared between our two products of cocoa powder, right, and any other products that we make from that cocoa. Okay, cocoa butter, cocoa powder, chocolate, whatever. They all share that same initial cost of purchasing those raw materials of cocoa beans. And so what we have to do for financial reporting purposes is we have to allocate those costs that we incur to purchase those raw materials associated with those cocoa beans between the products that we make. Okay? So let's take a look at that, and that's what I was saying right over here. We have to allocate those costs out for financial reporting. Okay? If we look back over here, this other concept that I wanted to talk about is this idea of the split-off point. And so what we say if the split-off point is this point in the production process at which we can recognize cocoa butter and cocoa powder or whatever other product that we make, chocolate, as distinct products, separate from each other, and of course separate from the cocoa beans. Okay? That's what I mean by the split-off point. And what I'm saying right over here is we have to exercise caution when interpreting joint costs. They're not relevant in decisions about whether we should further process joint costs or just sell the products as they are. So if we have, for example, what I'm saying by that is if we have cocoa butter, cheap cocoa butter, or the pricey, fancy cocoa butter, and we're deciding we've made some cocoa butter, should we further process it into the expensive cocoa butter or just sell it as the cheap cocoa butter? The price of the cocoa beans that we incurred that we then allocated to the cocoa butter, which we'll do here in a second on how to do that, is not relevant to our decision about whether we should further process that cocoa powder or cocoa butter, into the more expensive cocoa butter or sell it as is. Okay, so now let's come over here to page 275 and talk about how we can actually do the math to allocate out those joint costs, okay? And the one way that we can do it that we're talking about right over here is the relative sales value method, okay? And so that's what we're going to talk about is the relative sales value method. And the way that we do that is we do a proportion. We say sales value A divided by our sales value A plus B times our joint cost. And then here I say sales value B divided by sales value A plus B times our joint cost. And that's the formula that we use to allocate those joint costs to those products. And so let's take a look at a problem here that we have to do that. We have our American Produce Company purchased a truckload of cantaloupe that weighed 5,000 pounds for $1,000. American Produce separated the cantaloupe into two grades, superior and economy. So this $1,000 was for a whole truckload that contained superior and economy cantaloupes. The superior grade had a total weight of 4,000 pounds, sells for 30 cents a pound. Economy, 1,000 pounds, 10 cents a pound. Allocate that $1,000 joint cost. So the first thing, I have to figure out my total sales value, my 1,000 pounds for my economy times my 10 cents a pound, and then my 4,000 pounds of my superior at 30 cents a pound gives me 1,200. I add the two, that gives me 1,300, which is my denominator, my sales value. And then for economy, I take my 100 divided by my 1,300 times my 1,000 joint cost, and then superior, I take my 1,200 divided by my 1,300 times my $1,000 joint cost, and then that's how much would be allocated to each. And again, we have to do this for financial reporting purposes. Thank you.